Hello and welcome to the investment review for February 2013, looking back at last month's events. To reflect on markets, since the beginning of the year, the markets have been buoyant, largely as a result of the euro not failing in 2012 and the immediate threat of the US fiscal cliff having been dissipated by negotiations to raise the US debt ceiling. The markets have been pricing in a lot of positive news, and the upsurge in investment into equities is clearly a sign of rising confidence. As always, we continue to monitor market movements, but as any investor knows, it's absolutely impossible to call the markets and time efficiently when to enter and when to leave. The overriding question is whether or not one should actually be invested, and that's the simple decision that needs to be made. And generally speaking, that decision is answered when investors contemplate whether or not they are happy to accept the ups and downs of the markets. To avoid any nasty shocks, we guide all of our clients through a decision process to make their investments and help them choose the most appropriate portfolio for their individual tolerance toward investment risk. I'd like to talk a little about some state pension reform because once again the government has been tinkering with pensions. A new single-tier flat-rate weekly state pension of around about £144 a week is proposed to be effective by April 2017, which would remove the need for means testing for the pension credit for an increasing number of pensioners. To be eligible, people will need to build up 35 qualifying years with a minimum of 10 years, including national insurance contributions or credits. Contracting out of the state second pension, which we used to call SERPs, now called S2P, will cease, with an estimated saving to the Exchequer of around about £6 billion on national insurance rebates, and people who have contracted out of S2P with reduced national insurance contributions will find them increase. Any previously reduced national insurance rates from contracting out will be taken into account, and the flat rate pension would be reduced as a result. As usual with all pension legislation, it's not straightforward and further detail is to be provided, and obviously more analysis will be required. Inevitably, there will be winners and there will be losers. The new child benefit tax charge could affect over 1 million families, with an estimated 500,000 being required to complete a tax return by the 31st of January 2014 for the first time. Child benefit is a universal benefit, but it will soon become taxable to some. Once a householder's highest earner's adjusted net income exceeds £50,000, a tax charge will apply, clawing back the benefit. And when £60,000 income is reached, the tax charge will be 100% of the benefits claimed, wiping it out entirely. Before deciding to opt out, however, if one parent stays at home and has no earnings and is claiming benefit for a child under 12, that parent will receive national insurance credits, protecting their entitlement to a state pension. It begs the question as to what action you should take. People earning between £50,000 and £60,000 a year may wish to try to reduce their income to below £50,000 by means of pension contributions or salary sacrifice, both of which attract higher rate tax relief for contributions falling within the higher rate tax band. Deduct existing pension contributions from gross income in calculation to reach a net adjusted income. Please contact us to discuss your individual circumstances and advice on what action you should take if you think you may be affected by this pretty radical change. Turning to the US House passed a bill on the 23rd of January to extend the debt limit until the 18th of May, permitting the government to borrow hundreds of billions more to meet its obligations. The federal government borrows 30 cents for every dollar it spends. Failure to raise the debt ceiling would have immediately forced spending cuts equal to 6% of gross domestic product and led to a recession that would have had a knock-on effect on millions of people being unable to meet their own financial obligations. Of course, this would cause a pretty devastating chain reaction of defaults. Europe is another current hot potato for different reasons at the moment. The Prime Minister David Cameron's speech in Davos stated he wanted to renegotiate the terms of Britain's membership of the EU. The in or out referendum, promised in 5 years, may seem a long time in coming, but how this debate and uncertainty will affect the recovery in the UK and the Eurozone will remain to be seen. Some thoughts on China. Asia is projected to remain the global growth leader during 2013. We believe in holding some investments in emerging markets as part of a portfolio for long-term growth to take advantage of the way the developed world is expanding. However, predictions are unwise due to political uncertainties in several areas. Concerns over the slowdown in growth in China have eased, with economic growth stabilizing, and growth levels are expected to continue to increase steadily, but not at the past high rates. In the next decade, the impact of the one-child policy is likely to start to take effect, changing China from a country with a vast supply of low-cost workers to a declining working-age population and labour shortages. This change in demographics in China is expected to have worldwide implications. Thinking about then outsourcing, a recent report commented that the benefits of outsourcing manufacturing and services to Asian countries like China, Indonesia and India are becoming increasingly less attractive to some American businesses, as continuing wage increases in these countries compared to the USA narrow the profit margins. The disadvantages of separating production from research and development are becoming of concern to companies because reaction times to changing markets are often too slow, and the costs and time taken to transport goods affect competitiveness and overall performance. Some US companies that previously outsourced are now reshoring manufacturing and services much closer to home again, giving better control over quality, response time and costs. Outsourcing was partly blamed for unemployment statistics in the USA, so as more jobs are recreated, growth and productivity may improve as a result. This month, the charts give consideration to world markets rather than our individual portfolios, which each client who is currently monitoring their investments via our online services will be able to see have had a very buoyant time since the beginning of the new year. The commentary for this chart follows on the next slide. The graph on the previous page demonstrates the gradual upward movement in the worldwide markets during the latter part of 2012 and the beginning of 2013 as a result of policy actions lowering the crisis risks in the euro area and the United States. Global growth is projected to continue to increase modestly during 2013. To bring the review to summary, a negative real return on risk-free assets such as cash and gilts is likely to continue for 2013, and it's thought that interest rates in the UK will stay at 0.5% until 2017. So investing in cash for the next 4 years will almost certainly result in its real value eroding fairly significantly when we take into account inflation. Immediate concerns about the failure of the single currency in the Eurozone and the US fiscal cliff have faded, but there is still much to be done in both of these areas to restore investor confidence. Despite weak global growth in 2012, risk-based assets performed well, with both global equities and corporate bond markets outperforming all the risk-free assets. To achieve potential returns beyond inflation for 2013, it will mean remaining invested in a diverse portfolio of equities and fixed income instruments. Although markets are rising at the moment, volatility will almost undoubtedly continue. Therefore, anyone invested directly in markets is still going to experience the ups and downs for the foreseeable future. Obviously, we will continue to keep abreast of affairs, but in the interim, if you'd like to contact us, please feel free at any time. And I know I said this last month, but no charge will apply despite what you may be reading in the press about financial advisors having to charge. Contacting us is free at any time. It's just part of our service to all of our clients. Our contact details follow on the next slide. Thank you for listening.